This is not over. There's been a little bit of a sigh of relief. Stock market rallied a little bit toward the end of beginning of April. And okay, that's a normal reaction. But any thought that the problem's been solved, the bailout's complete, you're not going to hear more, is just not true. There's more coming. Get ready for it. I can't tell you. I'm not going to pick a specific name, and we all know the names of the big banks that might be in distress. Is Deutsche Bank or Barclays or HSBC Santander. I'm not picking on any of them. I'm just saying that there are more dominoes waiting to fall. The really interesting part about this, and again, we can come back to the specifics, is that the dominoes falling is a good metaphor. It's, if you got 100 dominoes, you knock the first one, they're all going to fall. That's just physics. So how do you stop that? How do you stop that crisis? Well, you truncate, you drop a steel wall between two dominoes, and this one hits the wall and this one's still standing. But that's the bailout. But the problem is each crisis tends to get bigger than the one before, which means each bailout gets bigger than the one before. My question that I'm wrestling with, are we now at the point where the needed bailout is bigger than the capacity of the central banks, that they've pulled all the rabbits out of a hat, played all their cards? And again, this goes back to what I did say about the Silicon Valley Bank rescue. It is the biggest bailout in history, and I can explain why. But if that's the case, and what else do they have? And then, so now we're dangerously close to the point where, as the crisis gets worse, it's no longer, oh, gee, let's wait for the Fed to bail it out, or let's wait for the ECB to bail it out. You get to the point, I think we're there, where you say, no, these guys actually can't stop it. And you lose confidence in the currency itself. It's the dollar. The crisis is the dollar itself, and the euro, goes along with that. And then that's the crisis. And there's no way to bail out a dollar crisis with dollars, because you're just pumping more of what people have lost confidence in. And then, then where do you go? And there are good answers to that. We've seen it again. We've seen it all before, but you have to kind of take the timeline out to 1,000 years, or the 1350s with the failure of the Bardi and Peruzzi banks in Florence, to see how these things can really play out. So this is big. It's not over. The regulators will attempt more bailouts, but we're at the point where I think you can start to question the regulators themselves. Brazil, Mexico, Argentina, the Latin American debt crisis, broadly defined in the early 1980s. That played out, the intense phase lasted about 3 years, 82, 83, 84. It wasn't until 1990 that we got around to Brady bonds, which were the ultimate refinancing technique. But the intense period lasted about 3 years. Come forward to 1998, long-term capital management. That was about 3 months. That was July, August, September 1998. SVB was 3 days or less. It was like Wednesday, Thursday, Friday, and done. We were moving $8 billion out of Silicon Valley Bank, and we got the wire transfer request in, but we didn't know, because you get to close business Thursday. We didn't know until Sunday that the money was going to move. We got a confirmation on Monday. We didn't end up moving the money, but there was about a 48-hour period there from Friday to Sunday when no one knew that the wires had been completed. The recipients didn't have them. It was just in limbo, and it worked out. And they talked about, all these small entrepreneurs and startups, they got 100 employees and 5 million in working capital, and that money's gone and they're all going to fail. There was something to that. But the fact is, you had Roku, Cisco, eBay. I mean, there were huge companies with multi-billion-dollar deposits in that bank. It wasn't all a bunch of little guys. So, but yeah, you can, in the old days, you had to line up around the block, and maybe it was raining, you're standing there in the rain waiting for your turn to get up to the tower. Now you can be in line at McDonald's, with your cell phone, and just a couple hits, QR code, and boom, $10 million is gone. And what Peter Thiel did, and he was right. I mean, I'm not criticizing him. He got his own money out, but he sent out like an SOS to Silicon Valley. He said, all of you, whoever you are, get your money out now. And a lot of people did, and that was that $40 billion. So the time frame is becoming more compressed because of technology. You're exactly right about that, which means that the response function has to be equally compressed, or else you are going to have all the consequences of an honest to goodness global financial crisis. So, and I'm not sure if everyone knows the sequence, but on Friday night, March 10th, the FDIC took over Silicon Valley Bank. And they issued a press release, and they said, here's what we're doing. We're taking over. We're putting it into what's called a receivership. Anyone with $250,000 or less, your deposits are fully insured. No worries. You'll have your money Monday morning. And over $250,000, your deposits are gone. They didn't say frozen. They didn't say suspended. They said gone. And they gave you a receivership certificate, basically an unsecured printed up IOU from the FDIC, but not money. And it's a receivership certificate. And they said, hang on to them. In effect, we're going to sell assets. And as and when we realize proceeds from assets, we'll give you something. We'll give you distributions on these things. Don't know how much, don't know when. We'll do the best we can. Remember in the RTC days in the early 90s, it took them 2 years, and they were very efficient. I worked with them at the time. We were in their offices when we were sitting on boxes because they didn't even have furniture, but they were doing deals. So they had the right attitude, but that took 2 years. So and that was it. Well, that's when I call the billionaire crybabies came out and forced Bill Ackman, all these guys. Oh, you got to save us, I was like, well, you got to trade on Bill. $5 billion is not enough. But anyway, they pounded on the White House all weekend. Now here's something that very few people say, almost nobody knew at the time except the management, although they seem to be asleep at the switch. Everyone's like, yeah, startups, venture capital. There's a lot of truth to that. 97% of the deposits at Silicon Valley Bank were uninsured. And by the way, that's my new metric for assessing banks. You used to look at, working capital and debt equity ratios and, bad assets, governments. There are lots of ways to measure the health of a bank. But the most relevant way right now is, and this is publicly available, take the ratio of uninsured deposits to total deposits. 30% is comfortable. If you're like, 70% of my deposits are insured, which means they're not panicky. They're not necessarily going to run for the hills. 30%, okay, uninsured, but I have assets. I have that much cash or more. That's a comfortable ratio. When you get over 50, you're in the danger zone. Well, Silicon Valley Bank was 97% uninsured, which meant all the money was going to run, and it did. So that's a way, if you're looking at these big banks or any institution or your own savings institution, to look at it. But Silicon Valley Bank was a climate bank. Were they investing in startups? Yes. Were they investing in technology? Yes. But these were climate. These were green new scam startups looking at battery technology, chemistry, physics, to try to make a better battery. But not much improvement in the battery in 200 years, but they're working on it. Wind turbines, other sustainable fuel alternatives, et cetera. Again, I'm not do that if you like, if that's your field of research, but so much as is subsidized by the government and then further subsidized by Silicon Valley Bank. And that's where the assets were. That's where the loans were, by and large. And so the White House is getting hammered, not only because of entrepreneurs, job losses, and by the way, we are in an election cycle here in the United States, but from the greenies, who are extremely powerful. Sunday night at 6 o'clock, by the way, mark that on your calendar. Sunday, 6 p.m. is when they tell you what they're going to do. 6 p.m. Sunday, November 12th, they came out on, March 12th, they came out on Silicon Valley Bank. The following week, 19th, that was Credit Suisse, and then the week after that was something else. But they always announce the collapse on Friday, and they announce the relief on Sunday, so they have the weekend to work on it. But you got to be careful about 3-day weekends. Easter, Easter is an example. If you have underwater bonds, U.S. government securities, treasuries or certain mortgages, you can ship them to us. We will give you a loan at par value. We'll give you cash equal to par value, even though the loans are only worth 80 to 85 cents on the dollar, because interest rates have been going up for over a year. The value of the bonds goes down. That's bond math 101. Rates up, bonds down, prices down. Rates go down, the prices go up. Well, the rates have been going up, so the prices are down. So these bonds are worth 80, 85 cents on the dollar. But here's the Fed saying, we'll give you 100 cents on the dollar for your 85-cent bond on a one-year loan. So the loan was important because it means they didn't actually sell them. It was collateral for a loan, except you're under collateralized. And the Fed's like, okay. I said, I have a 14-year-old car that my dealer says he won't give me any money for. So I sent a tweet out. I said, hey, Fed, would you give me the $70,000 I paid for it? It's not worth anything, but let's get back to par here. That's what the Fed was doing for the entire system. But the thing is, Brian, you're talking about multiple trillions of dollars of bonds that fit that description I just gave you. Now, the banks are kind of saying, oh, that's good. That's a good deal. I'll take that. I'll do that myself. Here's something under collateralized. You give me the cash on a one-year low interest rate loan. And now in theory, I've got all the cash I need to, pay depositors if they were taking the money out. But better yet, I don't have to record the loss.
Small ebook, big impact, the wealth tree. The only 4 ways that will make you financially free forever.
It's going to get worse. Inflation's here to stay. Commodities are going to boom. Oil prices are going to soar. Bonds are going to crash. And gold has been in a very funny situation, which is the following. Normally, you say, well, if there's inflation coming, why isn't the price of gold going to the moon? And why on earth would gold prices go up if there were deflation or disinflation? The answer is that you have to look at the yield to maturity on the 10-year Treasury note. That's our benchmark security. A lot of people look at LIBOR, but I'm like, no, if you're making investment decisions, you're buying a house, you're doing capital investing, these are all 5, 10, sometimes 20-year decisions. The 10-year note is the right benchmark for those large, long-term investments. Well, that's an alternative place to put money. You can buy gold, you can buy a 10-year Treasury note. So what's been true since last summer is as the yield to maturity on the 10-year note goes up, that strengthens the dollar, and gold prices have gone down because the dollar price of gold is just another cross rate, just another cross exchange rate. So a stronger dollar means a lower dollar price for gold. But if the yield to maturity in the 10-year note goes down, then that weakens the dollar, and the dollar price of gold goes up because a weaker dollar means a higher dollar price for gold. So curiously, the price of gold is being driven not by inflation in the abstract, but by the strength of the dollar, which is reciprocal to the interest rate on the 10-year Treasury notes. But here's what has changed. I talk about gold bull markets and gold bear markets, and I start my analysis in 1971. And I don't have to go through all that data, but that's how I think about it. And you're like, well, Jim, why 1971? Why not before that? And of course, 1971, it was when Nixon stopped redeeming dollars for gold. Americans couldn't even own gold in 1971. It was contraband. It was like drugs or machine guns or something. But foreign trading partners could redeem dollars for gold up until 1971. And then Nixon said no more. And then that was the final decoupling. But prior to that, gold was actually money. In other words, under Bretton Woods, gold was pegged at $35 an ounce. Prior to Bretton Woods, it was pegged at $20.67 an ounce. So going back to the 1920s or earlier, through most of the 19th century. For the United States, in sterling, I think it was $4.75. It could be off a little bit on that, but £4 and change. And as late as World War I, say 1913, if you were a Brit and you were getting on the steamer from London to, at the time Bombay, today Mumbai, you took a purse of British sovereigns. British sovereign is about 8 grams, a little bit less. It's not an ounce; it's a quarter ounce, because an ounce is almost too much. So even today, what are you going to do with a 1 ounce coin that's worth almost $2,000? You're not going to use that to buy a pack of gum. But in the day, there was the quarter ounce, which today would be like a $500 bill. So it's still a significant amount of money. But you could get on the steamer in Southampton and get off in Bombay at the time, and it was money good. You could take that British sovereign and spend it anywhere. And same thing in Singapore and Hong Kong and Japan or all around the world. So gold was actually money. So it wasn't a question of, what's the exchange rate? It was, the gold was the money, and people thought about it by weight. They said, a sovereign, that's 8 grams of gold. So that's worth, that'll get you whatever. So, and that was true throughout history. And so it's really only since 1971, when we decoupled completely in terms of an exchange rate, that you have to think about, what's the dollar price of gold? Because it's not fixed. But okay, well, what happened to the memory? What happened to the 3,000 years I just talked about? Well, the answer is it happened in stages, and it actually took about 75 years. So it began in 1914. 1914 was the outbreak of World War I. Everybody needed gold. There was a run on gold, and countries needed gold because they knew they would need gold to pay for the war, to try to win the war. Well, it didn't matter if you're Germany, UK, or whoever. And remember, the United States was neutral. The United States did not get in the war until 1917. The war started in 1914. So for those first 2.5 years, New York was a money center to all of Europe, to all the belligerents. So everyone scrambled for gold. So if you were a citizen, they asked you to bring your gold to the bank, and they gave you paper money. But people did it out of a patriotic. It's existential. War is not a normal market. If you lose the war, you got bigger problems than your gold. And so people put the gold in the banks. What did the banks do? they melted it down and made 400-ounce bars. And they said, don't worry, your money's backed by the gold, but keep using that paper money, but it's redeemable for gold. But oh, by the way, they're 400-ounce bars. Nobody walks around with a 400-ounce bar in her purse. I'm sure you've seen one, and I have as well. They're heavy. They weigh about 35 pounds. You don't walk around with them. So all of a sudden, the gold was still there, and the paper money was backed by gold in theory, but the gold had disappeared into the banks. That's step one. Step two, and this happened in the 1930s, the central banks took the gold from the commercial banks. So first, the commercial banks took the gold from the people. Then the central banks took the gold from the commercial banks, and the Federal Reserve System told all the banks, hey, send your gold to the regional Federal Reserve Bank. And of course, most of it went to the Federal Reserve Bank in New York. So now it's not even in the banks anymore, right? But you're still walking around thinking your paper money is somehow attached to gold, but people haven't seen gold for a while, unless you're a collector. Step three, the United States Treasury and the finance ministries took it from the central bank. In 1934, the United States Treasury seized the gold of the Federal Reserve System. Bearing in mind, the Federal Reserve System is privately owned. And they gave them a gold certificate. And you go to the Federal Reserve System website today and hunt around a little bit on the links and find the balance sheet of the Federal Reserve, and it's there. And look in the assets, and the first line item is gold certificate, and it's valued at $11 billion. But that's because they value the gold at $42 an ounce. And I've revalued it, the answer is that today's market, that 11 billion is actually worth 470 billion. So the Fed has a hidden asset of 450 odd billion that's not on the balance sheet, represented by a gold certificate. But it's not the gold. The Treasury has the gold. And by the way, where do we keep our gold? I'm talking about the United States. The Treasury owns the gold. The Fed has a paper certificate. The gold is on two Army bases, West Point and Fort Knox. So I would say the Army has the gold. Gold has gone from citizens walking around having it in your purse, to commercial banks, to central banks, to finance ministries, held on an Army base. It's still there. The gold didn't disappear, but nobody talks about it, and everyone pretends it's not money. But of course it's money. But meanwhile, what's happened to the civilian population, the citizens? We stopped talking about it. We stopped saying it. We stopped learning about it. I remind people, just showing my age, but I got a graduate degree in international economics, and I was class of 74. But that was the year the IMF demonetized gold. But I was the last class that was taught gold in an academic setting as a monetary asset. If you're younger than I am and you know anything about gold, you're either self-taught or you went to mining college, because they just stopped teaching it. So now we have two generations of scholars who never learned a thing about gold. So they hid it, they took it, they buried it, they stopped teaching it, they stopped talking about it, and they pretended it's not there. Meanwhile, it is there. And Russia is a good example of someone who takes it seriously. In the US, we still have our 8,000 tons, 8,133 tons. We haven't given it away. We haven't sold any gold since 1980, by the way. We got the British to do it. We got everyone else to do our dirty work. The British sold more than half, seriously, the British sold more than half their gold. The Swiss sold 1,000 tons. The IMF sold 400 tons in 2010. That was the last significant sale by a monetary institution. Australia sold most of theirs. Canada sold most of theirs. If I were one of these other countries, I would say to the U.S., hey, why don't you sell some of your gold? But the U.S. doesn't. We haven't sold an ounce since 1980. Everything I just described is playing out, and there's data to back it up, not just an inverted Treasury yield curve, which is interesting. Well, T+10 is the main sector where it's inverted, but even more profoundly in the Eurodollar futures curve. I call the Treasury yield curve a short-term bet on a long-term rate. The Eurodollar futures curve is a long-term bet on a short-term rate, because the Eurodollar future it's like we're betting on what an overnight rate is going to be 2 years from now. So a long-term bet on a short-term rate, and it's inverted, and it shouldn't be inverted. That should never, it does happen, but it should not happen. Yield curve should be upward sloping, just because time value of money and uncertainty, et cetera. If I lend to you for a longer period of time or make a further forward bet, I should get a higher rate. Well, how come people betting on overnight rates a year or 2 years from now think that rates are going to be lower? And that shouldn't happen. The only explanation for that is we're going to go into recession. It's going to get a lot worse. But going back to a really important distinction between a recession, even a bad one, and a financial crisis, because they're two different things. They can come together. But for example, in 1998, we had an acute financial crisis and with long-term capital management, and I negotiated that bailout. I had front row seat on that one. But 1994, the tequila crisis, and there was the bond market massacre. There have been these financial crises, but there was no recession in 1998. In fact, the NASDAQ went to the moon. We were looking, long-term capital, we were licking our wounds after the meltdown and, turning on CNBC and like watching pets.com, the sock puppet and all these things. They're going to the moon. Like, hey, we just got wiped out. But the opposite is true. You can have a recession without a financial panic. 1990, we had, kind of a mild recession. There was no financial panic then. 2020 was interesting. I don't know what to call it. I mean, technically a recession, but the economy drops 31% annualized in, they say 2 quarters, first and second quarter of 2020, but it was really 2 months. I mean, if you break it down, it was March and April. They happened to fall in 2 quarters and took both quarters negative, but it was really 2 months, down 31% in annualized in 2 months, and then up 35% by the third quarter. I mean, that was crazy. So maybe that's technically a recession. But that's just what happens when you shut down the economy. But there was not a financial panic. Stock market fell, but the banks didn't fail. Nobody's lined up to take the money out of Citibank, et cetera. So you can have recessions without panics. You can have panics without recessions. October 19th, 1987, Dow falls 22% in one day. No recession. But sometimes they do go together. In 2008, they did. We had both. We had an honest to goodness financial panic. Everyone knows, Bear Stearns, Fannie Mae, Freddie Mac, Lehman, AIG. But I can tell you, and I've spoken to a lot of people, Morgan Stanley was days away. And then Goldman would have been behind that, probably Citi, and maybe JP Morgan would have been the last one. And the economy collapsed and the stock market fell well over 50%, I think 60%. So that was an example of both. And what I'm concerned about is we may be heading into both. If everything I said about what's behind the curtain, the plumbing of the financial system, acute dollar shortage, scramble for collateral, which leads to deleveraging, because if I can't get the collateral, I got to take the trade-off. Leveraging of balance sheets, et cetera, which are the early warning signs of a global financial panic, and a likely recession. We could very well be looking at a severe recession and a global liquidity crisis, two different things, but they could converge. Got to give a little credit to Robert Shiller. He wrote a great book called Narrative Economics. Now, narrative is just a fancy word for a story. It's like, okay, you can call it a narrative and it means a lot of people buy into it, but it just means there's a story that people believe. And this goes back to the greatest sociologist of the 20th century, Robert K. Merton. There is no Nobel Prize in sociology, but if there were, Robert K. Merton would have won it. But he's the one who came up with the phrase, the self-fulfilling prophecy. And the classic case is you wake up in the morning, the bank's fine, but somebody gets nervous and they run down and take all their money out. And somebody sees them and go, what are you doing? So I'm getting my money out of this bank. Okay, I better get my money out too. And everyone's like, I don't want to be the last one out. Next thing you know, there's a line around the block. And by the end of the day, the bank shuts its doors and they're bankrupt. But they weren't bankrupt at 9 o'clock in the morning. It's because a story spread. People believed it. People acted on it. And that's the key. Do you act on the story? You can make the thing you're worried about come true, even though it wasn't true when the story started. Narratives can be true, but they can be false. In other words, a completely false narrative can be extremely powerful if enough people buy into it. The Fed pivot is a narrative, and it went like this. So inflation takes everyone by surprise in fall, late 2021. November 2021, Jay Powell says, time to retire the word transitory. And then inflation goes to the roof. The stock market goes down. It's still going down. But then after the Fed raised rates, and then the yield curve is inverted, the narrative is like, well, wait a second. The yield curve inversion is telling us that rates are going to be lower months from now. Inflation's cooling off a little bit, and it has. And so they're going to have to cut rates. That was the pivot. And rate cuts are good for stocks, so buy stocks. But then we get this rally and the stock market's, recovering a lot of this, not all the lost ground, by the way, but a lot of it, all based on the Fed pivot narrative, which I never bought into. I mean, you don't want to stand in front of a moving train. I wasn't going to short the S&P. I did not buy into the narrative. I said for two reasons. Number one, inflation came down from 9. Well, that's nice, but you say you want to get it to 2. You're a long way from 2. And how much demand destruction, how many rate hikes, how much do you have to do to really destroy the economy to get inflation down to 2? The answer is a lot. And tell me why that's good for stocks. And it's not. But the other reason is and this is a little more sophisticated analytically, but just because the yield curves are telling you that market pros think rates are going to be lower, doesn't mean the Fed's going to cut. That is the message, but it doesn't mean the Fed's going to get the message. How many times does the Fed get things right? The answer is never. The buy the dips crowd have not gone away. They're still around. I'll say talking heads, I guess I'm one, but the cheerleaders, I'll put it that way. The Wall Street cheerleaders have never gone away. The Wall Street always wants to sell you something. The people who think the Fed knows what they're doing, there's some of those. But the fundamentals have not changed. Forecasting the consequences of Fed policy is really difficult, but forecasting Fed policy is the easiest thing in the world because they tell you what they're going to do. But the hard part is what's going to happen as a result of that. And the Fed's thinking maybe hard landing, but not too bumpy. And I'm thinking more like a plane crash. Not to get too geeky, but sometimes I can't help myself. There's a concept, it's not that difficult. It's called DBO1, which is the dollar value of 1 basis point. And what it means is if interest rates go up, 25 basis points, what's the change in the price of securities? In other words, what's the rates up, prices down, rates down, prices up. That's just bond math, but it's not uniform or linear at all levels of rates. So when at higher rates, the DVO1 is lower, and at lower rates, the DVO1 is higher, which means the impact of every basis point increase in interest rates is greater at lower levels, right? So in other words, raising rates from, I'll just say 2 to 4 for a range is much more damaging to prices than going from 8 to 10. A much higher interest rate is a whole different world. But the impact of that on bond prices is less than going from 2 to 4, where it's like you're just putting these bonds in the cellar. And that plays out in derivatives world. So that's another factor, along with scarcity of collateral, shortage of dollars, quadrillion dollars in notional, deleveraging balance sheets, and a higher DVO1, meaning these interest rate hikes do more damage per basis point to bond prices than if they were at a higher level. That's definitely cause for concern.
What has been happening in the U.S. economy? The Fed prints all this money, yet that money doesn't lose a lot of value. Look at the exchange rate of the dollar versus other currencies. We've had this massive explosion of money printing, big increase in the Fed's balance sheet. But on a relative basis, the dollar hasn't lost a lot of value relative to other currencies, despite the fact that we've dramatically increased the supply. Imagine if the United States existed as an island. We didn't trade with any other nation. So any money the Federal Reserve printed just stayed within our borders. It didn't go anywhere, right? And so the only stuff you could buy with the money the Fed printed was the stuff that we made here domestically, because that was the only source of goods. Well, obviously the effect would have been much different, because if the Fed prints a bunch of money and we don't have any stuff, we're not producing, we don't have factories making stuff, then the prices are obviously going to go way up. But there was kind of like an escape valve that allowed the Fed to print a lot of money and it not push up the price of goods. And that was the fact that we have a whole world out there that was able to produce the goods that the U.S. economy couldn't. And we were able to take all the money that the Federal Reserve printed and then use that money to buy all those goods that were made outside the United States. So the Fed prints money, right? The government gets it, sends it to Americans. Americans take that money and buy Chinese goods with it. And now the Chinese send us their goods and we send the Chinese our money. So the money the Fed creates is shipped abroad. So it's not in America bidding up prices, but now the goods that the Chinese produced, they get shipped to America. So now we have all those extra goods to keep a lid on prices. And if you look at the breakdown of the CPI between goods and services, if you just look at services, you've seen a substantial increase in prices, even with the government rigging the CPI, because the cost of services has actually risen by more than what the government admits. But If you strip out goods, you'll see a much bigger increase in prices. Why? Because we can't easily import those services. There isn't a foreign alternative. You can't outsource that stuff because the services have to be performed locally. But when it comes to goods, more and more goods have been outsourced to cheaper production economies like China. And so that's kept the lid on goods prices. And so when you average the goods prices with the service prices, that's kept the measured rate of inflation lower. I mean, think about the low production costs in a country like China, which, 20 years ago, they were just starting out. They went through a long period of time where they had a communist system, not just in name, but in practice. And so you had a lot of very poor people. And as they began to embrace capitalism, wages started at a very low level. And of course, they didn't have a lot of the rules and regulations that we had. They didn't have all these environmental protections. And so the cost of manufacturing and the cost of labor, capital was all much lower in a country like China. And so we were able to outsource that production in order to keep costs down, even as the Federal Reserve was printing money. And of course, the money that we were printing, we were sending abroad. See, now normally this wouldn't work, because if you ran a big trade deficit like the one the U.S. is running, your currency would crash, because your trading partners would have all this currency, but they'd have nothing to buy, because the whole purpose of trade is that you export to import. You have a concept of comparative advantage. And if, as a nation, there are certain things that you can produce efficiently, and there are other things that you can't, rather than producing everything, you produce just what you can make efficiently, and then you trade that for the things that you don't produce efficiently, because maybe your trading partner can produce that more efficiently. And so by everybody concentrating on what they make efficiently and then trading, everybody ends up with more stuff, higher living standards, lower prices. But the goal of your exports is to pay for your imports. You don't just export for the sake of exporting. That's just a waste of resources. You export to pay for your imports. But what about America? You've got China and other countries exporting to the United States. They're not getting imports. They're getting dollars. And because the U.S. is the reserve currency, those dollars are actually valuable. And so our trading partners are content, or have been in the past, to exchange the products that they produce for the money that we print. Now, their willingness to continue to do that and pursue this arrangement, I think, is coming to an end. I think the world is going to tire of exchanging real goods for our paper, especially when they understand how much less that paper is going to be worth in the future than it is now, when they realize the box that the Fed is in with respect to its ability to control inflation, and the fact that government deficits are going to keep on getting bigger and bigger and bigger, putting more and more pressure on the Federal Reserve to monetize those deficits. And in fact, the reason that the deficits were able to get so big in the first place was because of this arrangement, because foreigners were willing to hold on to our U.S. treasuries and keep interest rates artificially low. That emboldened the government to go even deeper into debt, because normally a government that was this profligate would be punished by higher interest rates, and that punishment would change their behavior and cause more fiscal responsibility. But we never got punished. And as a result of that, we continue to pursue even more reckless policies than we had in the past. And so foreigners actually helped encourage this. And ultimately now they're going to be the ones that are going to put on the brakes, because they're going to stop enabling all of this debt. But it's going to be the Federal Reserve that is going to ultimately replace foreign buyers of U.S. treasuries. But of course, when foreigners buy U.S. treasuries, there's no new dollars created. They buy treasuries with the dollars that already exist. But when the Federal Reserve has to buy those treasuries, they have to produce even more dollars to finance it, which is inflation. And of course, if those dollars stay here, if they're not exported, then they are going to be bidding up prices. And this is what Powell doesn't understand. we are not going to be able to continue to export our inflation to the degree that we did. And we're going to start to see goods prices rising now. And of course, even if the Fed hadn't increased the pace of its money printing, the benefits of outsourcing our production to countries like China was bound to diminish over time as Chinese wages go up, as production costs go up. There is less of a benefit of continuing to shift production abroad. And of course, as we've shifted more and more production abroad, there's less incremental benefit from shifting more. See, in the early days of outsourcing, we got a lot of bang for the buck. But over time, that impact is lessened. And so the benefit that we got of having our consumer prices reduced as a result of that is also getting diminished. So it was going to happen anyway, but we've now dramatically accelerated it.
I write books and I also write several financial newsletters. So I'm thinking about topics all the time. And there's always one, usually I say, well, all right, this war in Ukraine is a really big deal. Got to cover that. Or financial implosion in China, really big deal. I got to cover that. Or what's going on in the U.S. and other topics. I could give you a long list, maybe the end of the dollar's role as a global reserve currency, et cetera. The difficulty now, they're all going on at once. Any one of those topics would, fill a newsletter or be a big topic, a heavy lift, but they're all going on at once. And number two, they're not unrelated. There are all kinds of correlations. The breakdown and collapse of the global supply chain, which preceded COVID. A lot of people say, well, COVID came along. Of course, it messed up the supply chain. In my new book, Sold Out, I've got very, very good documentation that shows the supply chain was breaking down before COVID. Now, of course, COVID made it worse. Yes. And the war in Ukraine made it worse yet. Yes. But this really started with Trump's trade war in 2018. So, that, like I said, there's a thread that runs through all these things. So, when you ask me that, I'm thinking, well, you want to talk about China, Ukraine, supply chain, they're all a big deal. The war in Ukraine is the most important because it's highly, highly significant economically and strategically. But of course, it's a human tragedy going with it. If Chinese real estate implodes, okay, there's some hardship here and there, but it's not like people being killed or maimed or forced into refugee status. And that is part of what's going on in Ukraine. So that's probably the biggest single one, but I wouldn't miss the fact that all these things are going on at once. It's interesting because I do have, kind of an international following, but there are certain pockets. I mean, there are certain countries where, there's interest in what I do, or my books are published in that language, et cetera. So I have a good German following, and of course the Germans want to know what's going on with energy, and Japanese following. The number one question, of course, everyone's concerned about inflation, but there's a big backstory there. But I always say when it comes to your own money, everybody has a PhD in economics. You don't need Larry Summers to tell you what's going on with your budget and your, ability to feed your family or keep a roof over your head. So people get inflation. It's one of the reasons it's so politically toxic is because it's unavoidable. You can't fudge it. You can't spin it. So people get it. But then from there, the question I get the most is, hey, Jim, is this going to cause a recession? Are we going to have a recession? And as recently as a few months ago, I would say, yeah, I think so. You can see it coming. And there's data. I never make statements like that without supporting it. There's a lot of whistling past the graveyard. I mean, the stock market is still greatly overpriced. There's still, the buy the dips mentality hasn't gone away. It's still there. You got people like Jim Cramer yelling, and there's institutional support. There's momentum trading. Of course, 95% of the trading is by robots. So all that's going on. So we haven't really seen the market collapse, stock market collapse that I would expect in association with a severe recession has not happened yet. This is just going to play out. It'll get worse as the year goes on. I mean, that is my expectation. I have my own models and I look at it closely. But if you listen to Michael Berry, Jeremy Grantham, Charlie Munger, these people have been around and they run, hundreds of billions, and they're saying the same thing. So, so every now and then someone will throw some statistic at me and I go, how long is your time series? And I go, oh, we took it back 5 years. I was like, talk to me if you've done it for 100 years, because that's a little more meaningful. But Jeremy Grantham actually did do a 100-year time series and looked at bubbles all over the world, 1929 US, 1989 Japan, 2000 dot-com stocks, and many others. And he said he's never seen anything like it. It's the greatest bubble of all time, real estate, stocks, and other asset classes. So yeah, I do. That is my view, but it's shared by a number of other analysts. And again, you have to remind people. 1929, everyone's like, yeah, October, I think 18th or 19th. It was late October 1929. The stock market fell 22% in 2 days. It wasn't one day. It was like 12% one day, 11% the next day. So 23% over 2 days. But that wasn't the crash. I mean, that was the beginning of the crash. This Dow Jones fell 82% from top to bottom. Now, it took 3 years. It bottomed in June 1932. Started in October 1929, so not quite 3 years, but that fell 82%, and that happens. So yeah, we're down. Nasdaq's down, bounced back a little bit, down over 20%. We're in bear market territory, but that's just the beginning. That's not what a full bear market, market adjustment looks like in the face of the kind of recession that I expect. The soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. That's not priced into markets. The markets are pricing in a soft landing. They're not pricing in a really hard landing. So you have what's called cost push inflation. That's where supplies choked off, or there's an embargo, or there's a shortage, natural disaster, a lot of things. It's coming from the supply side, and demand is inelastic, so you just pay up or kind of do without. We are starting with the cost push inflation, mainly the price of energy, but the price of food is a big factor. And of course, they're related. It's like here's the energy, here's the food. Where do you think the food comes from? To get the food, you got to feed the pigs and cows. What do you feed them? You feed them corn. How do you get corn? Well, you grow it on a farm. You need nitrogen fertilizer. You need diesel in your tractors. You get the food. You got to put it in a truck to get it from point A to point B. That requires diesel. The higher the diesel price, the higher the cost of food, because you're moving it by truck, et cetera. So these things, as I say, are linked. But food prices are going up substantially, and the two things you can't do without are gas in the car and food. So you have that cost push inflation, and you see that in inflationary expectations and inverted yield curves. And I'll come back to that because that's a really big deal. If you thought inflation was going to run away, as it did in the 70s, yield curves would be steeply sloping, and people would be in a frenzy to buy stuff. They're not. And the yield curves are not sloping, or upward sloping. They're inverted. They're going down. That tells you that, and we also see it's inflationary expectations. Inflationary expectations don't drive inflation here and now. What does is inflation here and now can feed on itself. Inflationary expectations don't drive it, but they tell you a lot. They're information rich. They tell you a lot about what people expect. What the yield curve is telling us, what inflationary expectations are telling us, and other factors are telling us is that, yeah, there's inflation now, but the Fed's going to kill it, and they're going to kill it by destroying demand and throwing us into a recession. And here's where it gets interesting, because you could flip from this kind of inflation to disinflation or even deflation very quickly. And people are definitely not prepared for that. Well, sorry, I shouldn't say that. Kind of everyday consumers are prepared for it. I'm not sure Wall Street and mainstream economists and policymakers are prepared for it. They're just extrapolating the inflation, saying, well, the Fed's going to kill it. Yeah, they might kill it, but at a price, at a very steep price. And consumers are really bracing for that. So the soft landing is a myth. There's not going to be a soft landing. It's going to be a hard landing. But that's not priced into markets. The markets are kind of pricing in a squishy landing or a soft landing or from the runways. They're not pricing in a really hard landing, and that is what we're going to get. We may have a very bad recession, possibly worse than 2008. So tell me why it's a buy signal for stocks if the Fed is throwing the economy into such a bad recession that unemployment is going to go up significantly and growth is going to come down, inflation is going to come down. Why is that a buy signal for stocks? Maybe at the bottom, and the bottom might not be till late 2023. Okay, yeah, there are opportunities to buy the bottom, but we'll be nowhere near the bottom. Bear market rallies are really interesting. Some of the biggest rallies in history have been in the middle of bear markets where you ended up losing everything, but for a couple of days or weeks even, it's the bottom's in, and you buy stocks, et cetera. So you have to watch out for that. So we're flying into a really bad recession. The stock market's starting to get the message, but you've got this pivot narrative. You can't quite get rid of some of the buy the dips people are still around. So count on them to, buy into what could be a horrendous bear market. You got your buy and hold crowd. Remember in 2000, 2001, the NASDAQ dropped 80%. And a lot of people got out, but they said, well, just hold on to it. Well, it did come back, but it took until 2015. I mean, that's a long time. A lot of people died in the meantime. You're waiting 14 years to get back to where you were. So those people are still around, but there is what I call the pivot crowd. So the Fed pivot is a narrative, and it kind of goes like this. Yeah, the Fed's tightening. We see that. Inflation is going to come down really fast. The economy is going to slow down really fast. Both of those things are happening. Inflation, a little less so, but the economic slowdown is there. And the Fed's going to get the wake-up call and have to cut rates. And cutting rates, that's the pivot. They're going to pivot from rate hikes to rate cuts. And that's good for tech stocks, so buy stocks. Now, that's the narrative. It prevailed in late July and most of August. The stock market did go up. There was a decent rally in the middle of what's become a bear market based on this Fed narrative that they were going to have to cut rates. There are two huge fallacies in that narrative. The first one is who says the Fed's going to get the message? And if you look at what Jay Powell said and what he repeated, we're going to raise rates. We're going to crush inflation. I've been following this for 50 years. I've never seen a Fed chairman use the word pain 3 times in one paragraph, but he did, and he meant it. He knows there's going to be a recession. They're causing it in part. Unemployment's going to go up. He said that. He tied unemployment to killing, basically demand destruction and getting inflation under control. He said, that's how we're going to do it. And you're already starting to see some early signs of that. So with that as their focus, who says the Fed's going to, get a wake-up call? Almost certainly not. I mean, they told us what they're going to do. They're going to raise rates. And then he said, if we see progress on inflation, we'll pause. But pause doesn't mean cut. It means just wait a long time, because at that point, core PCE, that's personal consumption expenditure, core, which excludes oil and food, and that's just how they do it. That's their favorite metric. You can debate whether it's the best one, but the debate doesn't matter because that is the one they use. Let's say that comes down to around 3.5. Okay, it's still not 2. Now, what Powell, which is their target, so what Powell said is, we don't have to keep raising rates to force it to 2. We just have to raise them enough that it'll get to 2 on its own. That's what they call restrictive policy. So, but that's not a rate cut. He said that might last for a year, all the way into 2024. That's when he was talking about rate cuts. Now, again, this can change, but they've told us what they're going to do. I always say, forecasting the Fed's the easiest thing I do, because they actually tell you what you're going to do, what they're going to do. You just have to listen and believe them. Now, the hard part is understanding how badly they're going to destroy the economy and when they're going to get the wake-up call. That's the hard part of the analysis. But telling what they're going to do is the easy part, because they kind of tell you. So the stock market notion that somehow they'll be cutting rates is just false. I was around for the 2008 financial crisis. I was around for 1998 financial crisis. I negotiated that bailout for LTCM. 98 was interesting because it was an acute financial crisis that came very close, within hours, actually. And I was in the room with the Treasury and Italian finance ministry and 19 banks and a thundering herd of lawyers trying to save the world. But we came within hours of shutting every market in the world. There was a $4 billion all cash. You couldn't use the word due diligence because there wasn't time. It was just, hey, the Fed wants us to do this, so let's just do it. So that worked. But it was a very close call. They would have shut down Tokyo and then around the world, London, and finally New York. And they would have opened days later. But that's how, with trillions of dollars of losses, it would have been worse than what actually happened in 2008. It didn't happen, but there was no economic recession at the time. That confuses a lot of people, because, and particularly if you're using 2008 as a frame of reference. There are financial panics and financial crises and liquidity crises, and there are recessions, some of which are severe. But they're two different things. 98 was an acute financial crisis with no recession. 2000 was a mild recession, but there was no severe financial crisis. Now, NASDAQ collapsed, but there wasn't a lot of leverage in NASDAQ. There was no contagion there, but it didn't spread because no banks failed, no major brokerages failed, et cetera. So in 1990, a mild recession, but no financial panic. October 19, 1987, interesting, stock market fell 22% in one day. Not a week or a month, but one day, down 22%. And that was a financial crisis, but there was no recession. So they're separate things. However, they can happen together. And 2008 was an example. There we had both. But I would encourage analysts to separate those two things. Again, they came together. It was horrific, but they can happen separately. My point is, what's coming is a very severe recession. The monetary tightening on top of a world where growth is deaccelerating, inventories are sky high. The funny thing about the supply chain, we all remember headline, supply chain's broken down, the shelves are bare. So all true. That was happening at the time, and that's when I started working on the book. But what a lot of purchasing managers did, and inventory managers, they doubled their orders. They said, well, or tripled the orders. They said, well, if the supply chain's breaking down and I want just a normal amount, I better order 3 times as much or twice as much just to get what I want. And they did. Well, what happened was by the summer, some of that pressure had been alleviated, and here come the shipments into the warehouses that are twice as much or 3 times as much as what you needed at the exact same time that the Fed was destroying demand. And so demand drops off a cliff, retail sales drop off a cliff, the warehouses go from being empty to being full to the rafters, and now all that merchandise is sitting there. So, Nike, just many examples. So what do you do when you're in charge of inventory? You cut prices. You don't want that inventory. It costs a lot of money to keep it in the warehouses, number one. Number two, a lot of it's seasonal. It's like, who wants to buy, a summer dress in December? Not too many people. So they just slash prices, and that reduces margins and reduces profits. So we're just kind of flying into the face of all that. With the Fed tightening rates into weakness, the Fed will be the last to know because they're very model driven and the models are badly flawed, mostly with the Phillips curve and their focus on the unemployment rate, which is not a good measure of what's going on in the labor force. So my expectation is the recession's coming. It's going to be really bad. Inflation is going to come down fast, but not quite fast enough for the Fed. They're going to keep raising rates, destroying demand, raising unemployment. And we're going to wake up with a severe recession, high unemployment, and a much lower stock market. Whatever your baseline is, probably treasuries, 2-year notes or 5-year notes or whatever, they will come down a lot. Not right away. We may still be a month or two away on this, but they'll come down a lot. The interest rates are a lagging indicator. Everyone's like, well, how could interest rates be going up if we're in a recession? The answer is, as you get closer to recession, who figures it out first? Well, the Fed figures it out last. They're usually the last to know. Wall Street is second last to know. The people who figure it out first are actual business people, entrepreneurs, restaurant owners, dry cleaners, taxi drivers, or even medium-sized businesses. They see it. If you're in the trucking business, it's real time. If inventories are sky high and new orders are being slashed, you're not moving anything by truck. So there are certain businesses that are concurrent. But the stock market is saying, the Fed's raising rates, inflation is coming down, but we think they're already at the terminal rate. But not only that, we think they're going to get the memo that the Fed will figure that out before they get to 5.25, before they raise rates in May, maybe even March. Maybe they're done. And because of a recession, this is the soft landing Goldilocks scenario, where the market's right, the Fed's wrong, but the Fed will realize that the market's actually right and cut rates, and if you're going to cut rates, buy stocks. That's Wall Street always ends every analysis with buy stocks. So here we see Wall Street in real time kind of bidding up tech stocks because the Fed's going to pivot and cut rates. When in fact, Powell's thinking, no, that's not happening until 2024. So that's what the Fed thinks is happening. The market thinks that Powell is over tightening, that inflation will come down faster and the pivot will happen sooner. And that's why we've seen a little bit of a rally in stocks recently. So you have the Fed narrative, that's plan A. You have the market's version of what the Fed's actually doing, which is plan B. My estimate is that they're already past the terminal rate. They don't know it. They don't think so, but they are. And as I said, inflation is going to come down a lot faster than anyone expects. I talked about how the Fed is blundering because they're raising rates too high, too fast, et cetera, and they are. But the Fed has always said, we don't worry about inflation. We don't like it, but we know how to get rid of it. We just raise rates, and maybe they got to raise them longer and further than people expect, and maybe it's painful. There are costs involved, but they can kill inflation just by raising rates. They don't know how to stop deflation. I mean, how do you stop deflation? You can't raise rates. That'll make it worse. You can go to zero, but that doesn't, once you're at zero, you're at zero. QE doesn't work, by the way. It's been tried to the tune of like $9 trillion, but the empirical evidence is that it's just, they do QE by buying bonds from the banks, and the banks take the money and give it back to the Fed as excess reserves. That money never goes to the economy. What good does that do? And the answer is it doesn't do any good. It's a triple, greatest bubble of all time, times 3, in the sense that it's real estate, stocks, and other asset classes. So I do. That is my view, but it's shared by a number of other analysts. If all that's happening, and the fundamental signs are also weak, which we just saw in third quarter GDP, which is based on net exports, which won't last. How are you going to drive a trade surplus with the strongest dollar in 20 years? Good luck with that. I mean, nobody can afford our stuff, and we're not buying anybody else's stuff. So with the economy going into a recession on its own, with a global liquidity crisis brewing, why on earth is the Fed raising rates at all? They're two different things. The global economy is the big topic. That's what we all care about most. But financial markets can come up with their own narratives and go their own way, at least for a while. So you have to, they're not in sync. They will be in sync eventually, but not always right away. A lot of times the financial markets get ahead of themselves, and then they wake up to reality and they, crash, correct down. But in terms of the global economy, I think your use of the word global is very much on point, because it's often the case that, you look around the world, you've got the United States, or, North America, if you want to throw in Canada, you've got the EU, you've got China, you've got Japan, they're all important economies. But they can kind of be in different parts of the business cycle. And it's not unusual for one part to be in recession, but another part of the world is like doing better. So then they use the phrase locomotive theory. The locomotive is going to pull us all out of the ditch, and we'll get going. So it's not unusual to have recessions in the United States or Europe, or particular countries in Europe or Japan. I mean, Japan's had 9 recessions since 1989. I mean, 9. I consider that one long 30-year depression. That's a debate for another day, but that's how I would describe Japan. But it usually, one's not doing so well and another part of the world's doing better. That's not the case. What is happening right now, I see it, but there's an awful lot of data to back it up, is that we are going into, or may already be in, a global recession. So the global economy is in bad shape. It's going into a recession. Now, a lot of people have said that, we're going to have a recession as if it's no big deal, but they're expecting a mild recession. I see a much more severe recession based on a lot of factors, some of which we've spoken about. Now, the other half of your question, which is important to listeners, is what does this mean for financial markets? And there, the best way I've been able to explain it, imagine you're in an Irish pub and you got 3 Irish storytellers. And I'm part Irish, so I can talk about the Irish, but they're telling 3 different stories, and you got to listen to each one. So there's the Fed story, the market story, and then there's something called reality, what's actually happening. So the Fed story kind of goes like this. The Fed, forecasting what the Fed's going to do is the easiest thing I do. It's not because I have a crystal ball or I'm smarter than anyone else. The Fed actually tells you All you have to do is listen and believe them. Now, a lot of people don't listen, or they listen like, oh, the Fed will never do that. They will. They actually mean it. You know, Japan had the famous lost decade. Well, the lost decade was 20 years ago. Started in 1990 through 2000. Japan's now almost at the end of their third lost decade. The United States has had a lost decade from 2007. We're probably, if something doesn't change, either in terms of policy or a collapse, something gets worse. But absent that, we're going to remain in this kind of punk 2% growth as far as the eye can see. You know, people say, oh, well, you know, second quarter GDP, Atlanta Fed predicts, 4.5%. Yeah, but we've had 4 and 5% quarters in the last 9 years. They don't last. You get these spikes, you get a real good, 4% print, and then the next quarter is 2%. The one after that is 0.5 or maybe even a negative quarter. So the headwinds, demographic, technological, productivity, psychological, etc., haven't changed, and there's no reason to expect they'll change. So you can't understand debt in isolation. You have to understand debt relative to income. And that debt to GDP ratio, which is something I spent a lot of time looking at, the GDP is kind of chugging along, not going up very much, but the debt's going like this. The debt to GDP ratio is getting worse.